are boosting manufacturing in Europe. So these are a few of the stocks that really helping all of the green on the screen that Kelly was talking about.
There's lots of it out there. It's interesting to see, and we were talking about this earlier, avocado prices up 38% year to date. Chipotle clearly able to pass on some of that cost. Abigail, great work. Thank you very much indeed. Bloomberg's Abigail Doolittle on what is happening with the markets this Wednesday. Let's talk about what is happening to another aspect of this inflation story, the bottlenecks, the supply chains. The focus has been firmly in this area really since this time last year. Earlier on we spoke to Maersk's CEO, Søren Skou. He thinks actually these disrupted supply chains may be starting to heal now, and we may be just a few months away from starting to return to normal.
We're coming out of a pandemic and we don't have much experience with that, to be honest. So basically what we are saying, we expect quite a strong first half of 2022, and then we expect what we call a normalization early in the second half. That's what will give us a result which is very similar to the one that we had last year, which was record-breaking in every dimension.
Søren Skou, A.P. Møller Maersk's CEO, talking to Bloomberg a little bit earlier on. Let's carry on the conversation now. Gene Soroka, the Port of Los Angeles Executive Director, joining us now. Gene, great to see you. Thank you very much indeed for your time. Søren Skou thinks maybe we start to see things normalizing later on this year. Are you with him on that?
I agree with my friend Søren. We're seeing, Guy, a movement of cargo pretty heavily through Lunar New Year, landings here in Los Angeles towards the end of this month of February. North American retailers continue to tell me they'll use Q2 to replenish inventory and get that safety stock at a more comfortable level. Then we'll have a chance, if we hit these two marks properly, to pivot into an earlier than normal peak season, end of June, early July.
Are you going to be able to do so on the labor side?
Three segments of labor. We still need a lot of folks on the job in the warehousing sector as well as trucking. But what you're alluding to is the contract with our longshore dock workers that's set to expire on June 30th. Those dock workers have been out on the job an average of 6 days a week since the pandemic began. They kicked off their annual caucus to prioritize negotiating points that will be driven when they sit down at the table with the Pacific Maritime Association later in the second quarter. I'm optimistic. You've got professionals on both sides of the table negotiating. These dock workers need to get paid what they're worth. There are several other issues that need to be tackled. I think everyone understands what's at stake here economically.
One other aspect when it comes to labor, Gene, is obviously what the impact of Omicron in terms of labor outages. The longshoremen have been working incredibly hard. Everybody's been trying to work very hard to get some of these backlogs cleared. But Omicron obviously has caused people to be out. What are you seeing right now? How quickly is that story healing?
Like many around the world and right here at home, Guy, the longshore dock workers got hit hard by Omicron. Probably about 10% of the workforce here in Southern California tested positive. Thankfully, those positive test numbers are going down every day. The workforce is getting stronger, and we didn't miss a beat with the cargo flow. Those numbers that we look at, Guy, and that we've talked about before on velocity of cargo are all improving, and it's because the men and women have been out there each and every day. So I'm optimistic the month of February starts to see folks come back into the workforce. But again, even with those out sick, we did not impact the productivity here.
On the subject of the pandemic, we've seen and continue to see some pretty intense protests in Canada over vaccine mandates. When it comes to trucking, it's closing some key conduits between Canada and the U.S., specifically a bridge in Detroit. Could there be any ripple effects of that when it comes to trucking and logistics in the U.S. that reaches the Port of Los Angeles, Gene?
It's always a concern, and we're keeping an eye on it every day. The American Trucking Association has stated many times that we're about 80,000 drivers short nationwide. We need more drivers in the port drayage industry here. It's not a matter of not having enough drivers. We've got over 660,000 commercial licenses that have been issued in the state of California. About 18,000 of those folks are registered to do business here at the ports. We need to make these jobs better. They need to be professionals. Yep. We need to attract, recruit, and retain folks in this industry and pay them what they're worth as well.
Well, Gene, on that note, there is certainly a push by some of the contractors, some of the trucking contractors, suggesting that they should be unionized. Do you think that would go some way, unionizing some of these contractors, making them employees? Do you think that would go some way towards maybe improving those conditions, allowing a better dialogue, and maybe improving some of those shortages that you're suffering?
I do, but it's always a choice of the worker to see how they want to go on the job every day. What we've seen across the United States and even here in Southern California is that those folks who work in union organizations are just about in full employment every day. It's those who are unrepresented that we continue to see struggles with, whether it be pay, filling jobs, or requirements on shifts. That conversation needs to go a lot deeper, and it has to happen now.
As we move forward into the year when in theory some of these things may be getting better, what is the biggest risk that you see?
Well, we've got to do three things right now. Number one, while focused on everything else that we've been chipping away at for the past year and a half, we've got to look at improving American exports, getting our farmers and manufacturers back in the international game. Secondly, we've got to get these vessel services back on time to their scheduled performance standards, bringing certainty to the international and domestic supply chains. And the way to do that on both sides is enhance this look at supply chain digitization. We got to fan out from here in Southern California, bring in more participants, and have a nationwide look at information sharing. If we don't take this spotlight that's been on us and use it to improve the supply chain, the risk is we go backwards again.
All right, Gene Soroka, Port of Los Angeles Executive Director, thank you so much for your time. And coming up, speaking of supply chain issues, shortages, we're going to talk about the global chip shortage as well as tariffs and the impact that blockade we just asked Gene about is having on the U.S.-Canada border. We'll have a wide-ranging exclusive interview with the U.S. Commerce Secretary Gina Raimondo next. This is Bloomberg.
Find answers now.
We welcome now our TV and radio listeners, our TV audience and our radio listeners. We're bringing you all together because we have the great privilege to be joined by Gina Raimondo, the U.S. Secretary of Commerce. We're also alongside Bloomberg's David Weston. David, over to you.
Thank you so much, Guy, and thank you, Madam Secretary, for joining us today. It is indeed, Gina Raimondo, it is a privilege. I want to start with something that happened yesterday. The House of Representatives passed its version of a statute that's been called various things. I think it's now Make It in America Act. But in some substance, it really would invest a fair amount of money, $50 billion, in designing and manufacturing semiconductors here in the United States. Now it goes to conference. Give us a sense of what the impediments are in Congress. Is one of the biggest ones the $45 billion in the House version, not the Senate, to invest in supply chain?
Good morning, David. It's always great to be with you, and thank you for having me. So I first want to say it is impossible to overstate how consequential this bill is. As you say, it's a $50 billion long-term investment in American manufacturing of semiconductors, which is a uniquely critical component. It's headed to conference, as you say, and there's a huge amount of bipartisan support for the vast majority of the bill. In both the House and the Senate. I have just this week spoken with chairs and ranking members of the committees in both the House and the Senate, and also to Speaker Pelosi and Leader Schumer, and everyone is focused on getting it done quickly, and getting it to the President's desk. So I'm sure there will be ups and downs and disagreements, but we are all optimistic that it's something that can happen reasonably quickly.
Well, that's really reassuring to a lot of people who are concerned about this, but specifically on the supply chain issue, which, as I understand, is one of the differences in two bills. You have been responsible on supply chain here in the United States. How critical is that $45 billion in the House side to get done what we need to get done, separate and apart from the semiconductor investment?
Yes, thank you. It's extremely important. Now, and by the way, there is broad bipartisan support for that as well, and the President had a similar proposal in his Build Back Better proposal. Whether or not 45 is the right number and it needs to be that large is a legitimate, discussion. But what I can say is there is no department in the federal government currently whose mission it is to monitor our supply chain, which is really mind-boggling if you think about it. So the proposal is to create, for the first time ever, an initiative here at the Commerce Department to monitor supply chains, make sure we have resilient supply chains, predict bottlenecks before they happen, invest in domestic manufacturing, which is why this is now being called the Make It in America bill. It has to happen, David. So the precise details, we will work that out in conference. But I think we're all living every day with the disrupted supply chain. We can never let that happen again, and that's what this bill is designed to prevent.
Madam Secretary, good morning. It's Guy. Thank you for your time today. Even if this passed today, even if this became reality today and money started getting spent today, it would be years before the first chip rolls out of the first fab. What can be done now to deal with the supply chain shortages in the chip sector that industry is having to grapple with day after day?
Yes. Let me say this, Guy, and I know you know this, and every business leader will agree with this. Once this passes, the President signs it, that in and of itself is going to unlock private capital. I was in Ohio the other day with the CEO of Intel. He made an announcement of a $20 billion facility in Ohio. He said he did that because he's assuming the CHIPS Act will pass, and if it does, it will unlock another $80 billion. So I think we cannot underestimate, industry is watching this. Industry needs this. Why do we need this? Because we want them to put these facilities in America. Right? They're going to put these facilities somewhere to meet the demand. They need to be in America. So getting this passed now is among the most important things that we can do. Beyond that, the other things we can do now are just to bring together suppliers and consumers to increase transparency, which we are doing, encouraging the information sharing so that we can be sure there's no hoarding, there's no stockpiling, there's no price gouging. All of that transparency, which is what we are leaning into, increases trust in the supply chain, which will get rid of some of the bottlenecks. Long term, though, it's no free lunch here. The reality is we need to produce more chips in America.
More chips in America. You spoke a moment ago as well about making sure that they were produced in America. Madam Secretary, yesterday the EU unveiled its version of the CHIPS Act. The numbers are roughly similar. Now, clearly other factors are going to come into play here, but are you now in a position where you're having to compete globally? Other regions, other countries are looking to do the same thing. Is this an arms race that you now find yourself with?
Well, the reality is we're already in that global competition. China is pouring hundreds of billions of dollars to subsidize its chip manufacturing. So this is about competing, America competing, strengthening American manufacturing. As it relates to the EU, they are among our strongest allies, and we are already in discussions. One of the things I lead along with Secretary Blinken is the U.S.-EU Trade and Technology Council. And in that council, we talk a lot about how do we coordinate our investments so that it isn't a race to the bottom, so that we have complementary investments, so that together the U.S. and the EU are stronger, quite frankly, less reliant upon China.
Well, let's continue the conversation about China, Madam Secretary, because the Commerce Department in data yesterday made it very clear that they haven't held up their end of the bargain on the trade deal struck in the previous administration with the Trump administration. Only had purchased about 63% of the $200 billion worth of additional goods. Some of your colleagues in the administration has said the difficulty is there's no way to hold China to account on that. Is the administration going to let China off the hook?
No. President Biden has been very clear. This so-called Phase 1 agreement we inherited from President Trump. It's not necessarily, it's definitely not what we would have done. Having said that, China signed up for it, and we intend to hold them to account. And Ambassador Tai, the U.S. trade rep, is in the thick of those negotiations now. But the reality is, and you saw it in the report that the data Commerce put out yesterday, China's not playing by the rules. They're unfairly subsidizing their companies. America can win. American entrepreneurs and businesses can outcompete anyone if everybody plays by the same rules and we have a level playing field. And what you saw in that data yesterday is China's not doing that. So we absolutely are going to hold them to account to live up to the commitments that they made, that they signed up for.
Madam Secretary, I want to turn our eyes to the north a bit here, if we could, to Canada, because there is that issue with the Ambassador Bridge between Detroit and Windsor. You know it well. I'm from Michigan. I've been across that bridge a fair amount of time. It really is the major point at which trade is exchanged across that border. What efforts are we making to try to help Canada on that problem? Has President Biden, spoken with his counterpart, Mr. Trudeau, in Canada? Have you talked with your counterpart?
I have not yet. Secretary Buttigieg, Secretary of Transportation, I know, is deeply engaged in this, and as is Customs and Border Patrol. We need to resolve this issue. At the moment, we aren't. I have been in touch with the auto companies and such. We are told it is not yet interfering with supply chains. However, it will. It's only a matter of time. So we, the administration, are aggressively engaged trying to diffuse tensions and increase the traffic flow. The other issue, as you know very well, being a Michigander, is folks forget about cargo. Folks use that to get to and from work. And so we have to get traffic flowing again.
All right, Madam Secretary, thank you so much for your valuable time. U.S. Secretary of Commerce Gina Raimondo, as well as Bloomberg's David Westin. Thank you very much. This is Bloomberg. Guy. Admittedly, I've been waiting for this all hour because we are now going to talk about NFL football. And I actually have a valid excuse for doing so today because the Bloomberg Big Take story, which you can find at NI Big Take on the terminal as well as online, focuses on the NFL and specifically its changing attitude toward gambling when it comes to professional football. The league originally was very skeptical about this. Now it has embraced it fully, Guy, to the point where some of these companies, the likes of DraftKings, others, are sponsoring lounges within stadiums. You have owners like Bob Kraft and others that are invested in some of these companies. It's fully embraced gambling, and I bet there's going to be a lot of people putting money down on the game on Sunday.
Absolutely. Isn't the irony, though, that it's being played in California and that is a
Yes.
state that is yet to legislate? So no gambling in California.
Yeah.
Which maybe will take the sort of the edge off a little bit, but other states can definitely do it. So if you were to bet on this weekend's game, and I'm sure you're thinking about this, which way would you go?
I'd go with the Bengals, which is a little against consensus, but I have a lot of confidence in Joe Burrow now that he's out of his rookie year, and I think they have that underdog mentality, which I always like. So we'll see, Guy, but it's not even just about betting on who wins or loses the game or even point spreads anymore. You can bet on if Joe Burrow is going to complete his first pass, if Von Miller will successfully sack him at any point in the game. I mean, you can bet on pretty much anything at this point.
Can I just point out that I think Kaylee Lines is up quite early on Monday morning.
Yes.
It could be a brutal Monday morning. I'm not sure what time the game finishes and what time you're up, but I imagine the spread between those two
Very narrow
is
window.
fairly small.
Yeah. It's worth it, though, Guy.
Okay. I have no doubt that you will end up at least watching the highlights on your way to work. Maybe you'll have gone to bed early, but at least watching the highlights. I actually suspect that Kaylee Lines is going to stay up. As you may have noticed, she's fairly engaged in this subject. Certainly knows a lot more about it than I do. European equities, I don't know much about those either. European stocks are tracking higher today. We're up by around 1.8%. I think the real story, though, is some stabilization in peripheral yields. We've got a bid in BTPs. We've also got a bid back in Brent crude as well, which is significant. Tracking a little higher, up another 1% right now. Close is coming up. This is Bloomberg. Wednesday the 9th, European stocks firmly higher. Technology and autos leading. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
European stocks continuing their climb back out of the January hole. We're up quite nicely today, up nearly 2%, 474 on the stock 600. We're near session highs. The early gains really have done most of the heavy lifting today, but we've been climbing since then. The auto sector is doing well today. Technology climbing back as well, which is quite significant. So as we approach the close, European stocks definitely on the front foot. We're also seeing some stabilization in the bond market as well, which is significant. Post that Thursday shock from Christine Lagarde last week, we've seen bond markets battered, particularly in the periphery. Italy today showing signs of stabilization. We're also seeing a little bit of stabilization back in Brent crude, but from very elevated levels, 91.70. We're up another percent. Kaylee.
Stabilization seems to be the name of the game here in the U.S. as well, Guy. Calm pervading for now. The question is, could tomorrow's CPI print change any of that? Investors waiting to see, but at the moment they are indeed buying equities. We're up 1.3% on the S&P 500, gaining now for a second day. And what's notable is volatility continues to come in. We're back to a 20 handle on the VIX after just weeks ago it had blown out to the highest level in about a year. Calm in the bond market as well. You are seeing a bid coming in to treasuries. We're down about 3 basis points on the U.S. 10-year yield. 193.25 is where we sit. We didn't get that taste of 2% that we thought we might get yesterday. Does this conversation look a little bit different tomorrow post CPI? We will wait and see. And you mentioned oil. WTI now back at a 90 handle as well after you saw a big draw on inventories data here in the U.S., Guy.
Kaylee, as you talk about that VIX coming down to around that 20 handle, people are certainly paying attention to the volatility outlook. Are we going to see volatility continuing maybe to suppress a little bit more? Or are we going to see more, not less? That is certainly one of the questions the market is asking itself. I have to say that BlackRock's vice chair, Philip Hildebrand, he's got a pretty clear view on this. He spoke to Bloomberg TV a little earlier.
This is not an overheating economy. We're still growing below potential. So the idea here is these are inflation dynamics, very unpleasant, not acceptable in many ways, but they are driven by supply constraints, not by an overheating economy, and that will lead to a more muted cycle in the end. But until we get there, we're going to see a lot of volatility.
A lot of volatility. Mr. Hildebrand, formerly, of course, of the SNB. Well, let's get another take on this. Miles Bradshaw, head of global aggregate fixed income strategies, joining us from JP Morgan Asset Management. Miles, let's talk about the journey we've been on over the last few days. The focus, maybe you could argue, more on the bond market than the equity markets. Today, we're seeing some stabilization in the European bond markets, certainly. But is your expectation that we are going to see an ongoing increase in rates on both sides of the Atlantic? What's priced now? How much more is still to come, do you think?
Yeah, I think it's a world in which value is now being created in the bond market. But as an investor, it's time still to be patient. I don't think assets are yet cheap enough, and that implies that we can have high yields to come. And clearly, really, we're in a world where we're waiting to see the inflation data to have confidence about the direction or speed of rate hikes. But I think we're still in a world, and I'd agree with that, where we should be bracing for more volatility rather than less for the time being. So now's not quite the time to be loading up the boat with fixed income. I think we can be patient, but value is being created.
And obviously there's been a lot of turmoil on the sovereign side. What about on the corporate side? Are you getting nervous about some of the signs we're starting to see of a spillover into the credit markets?
Well, it was interesting. I was looking the last few years, the last 7 years, there's only 1 year where the ECB has not been buying assets. So the amount of bonds that the market has to buy in terms of credit new issuance over the next 12 months is going to be double what it was last year. So prices have to adjust, and we've put ourselves in a position where we can actually buy those assets because that's what we want to do. We want to be buying cheap assets. I think the moves we had last week was on very thin liquidity and there wasn't much market depth. And I think it will take investors quite a while to reorientate their portfolios as they have been used to ECB support and ECB suppressing volatility in markets. And the speed with which the ECB has changed its mind has been very rapid. So there has been very little time for a lot of investors to reposition their portfolios.
Just in terms of what we should expect from inflation going forward, and this is the real nominal debate that obviously everybody's having at the moment, trying to figure it out, both in Europe and over in the United States again. Where inflation may peak, like it may peak tomorrow when we get the print out of the United States. It may fade from there, but where it fades to is significant. And what that tells us about where the terminal rate in this cycle is going to be, where investors should look for in terms of some protection against that inflation. Where do you think inflation is going to settle out at? Is it going to be circa 2%? And if it's circa 2%, as Elizabeth Schnabel is maybe saying over at the ECB, talking right now actually on Twitter, inflation moving towards 2% in the medium term, what does that imply for bond investors in terms of the yield that they should be demanding?
Well, I think both central banks, the key central big ones, including, I'd add the third one, the Bank of England, have clearly signalled that they want to raise rates to make sure that inflation does settle towards their target. And I think if inflation does overshoot, we should not be surprised if they're willing to raise rates more than is currently priced in order to bring inflation down. And to be clear, it's about inflation falling less quickly than expected. So I'm confident inflation will be round and about target, but I think we may need higher rates than is currently priced in to deliver that. And that's because really I think central banks have found themselves behind the curve and the economy is in a much better place than they expected. We've almost got full employment in the US, inflation at target. That would imply interest rates should be around neutral, whereas in fact they're close to zero. So there's a great deal of that with which they've got to move interest rates merely to remove the stimulus before they can even think about tightening policy, potentially to slow growth.
So you think this peak hawkishness narrative that it seems to be a growing chorus of people talking about, you don't buy into that?
I think this is going to be, 2 steps forward, 1 step back, because the key calibration, as it were, is the extent to which you can raise rates without destabilizing financial conditions. Or to put another way, you've got to keep relative stability in corporate bond markets and stock markets in order to realize the expected path of rate hikes. And so until we get the data, the Fed will not be confident about the expected path of hikes. And so it will be an element of 2 steps forward and then reassuring the markets that they're not planning to do anything dramatic right here, right now, until we have the data, and then we may find that actually they may indeed be slightly more hawkish than they previously said. That's the evidence so far with what we've seen over the last 3 months from both Bank of England, Fed, and the ECB.
Miles, how are you thinking about peripheral Eurozone bonds right now? Famously, the ECB has been in the business of managing spreads. Do you think it still is?
No, I think the ECB is in the business of making sure that inflation falls towards target, and that's clearly the priority. To the extent that spreads widen, it tightens financial conditions, it slows growth, it means that inflation is more likely to be moving towards target. So they don't want instability, and I think the move we've had so far is not instability. We're back to levels we were in 2019. Financial conditions have not tightened that dramatically. So I don't think they would be uncomfortable with the moves we've had so far. But clearly, if they were to very quickly move to over 200 basis points, you would expect the ECB to soften their language. So as much as anything, it's about the speed of the move. But again, the ECB have been buying bonds for 6 out of the last 7 years. So we should expect something to move and some disruption to markets as they accelerate their taper.
So obviously the ECB watching spreads between core and the periphery. For the Federal Reserve, they are watching spreads within the Treasury market and a persistently flatter yield curve. Miles, how much more can it flatten before the Fed starts to get uncomfortable?
It's a good question. I think, we got down to about 20 basis points last time and the Fed started to be a bit uncomfortable. So I think that's the order of magnitude. But I also think that the key difference between this cycle and 2016-18 is it's global. In 2016-18, it was the Fed that was moving on its own. All right, the Bank of England moved rates a couple of times. Now you've got the ECB that's potentially going to be moving rates. And even in Japan, you potentially have possibly a change in yield curve control targets. And those two central banks have been an enormous suppressor of long-term bond yields simply by portfolio flow effects. So I think this time is different than the last hiking cycle in the sense that it's global, and indeed that may help the yield curve stay slightly positive, but I don't think we're going to be looking at a steeper yield curve because really the drive is driven by inflation and the central bank's reaction to that inflation.
Miles, as you say, central banks have anaesthetized global bond markets, global asset markets over the last few years. As that is removed, as the patient starts to wake up a little bit, where does the maximum sort of sensitivity lie? How sensitive do you think these markets are going to be to bad news? They don't have that stabilizing hand that they once had from central banks. Coming back to the volatility question, what is that going to look like, do you think, as we work our way through our recovery? You look at what is happening in Eastern Europe, for instance, you get some bad news there. How sensitive are these markets going to be?
I think it's got a lot to do with market depth, and that does imply that markets perhaps will be quite sensitive and more sensitive than in the past. But I think there will be a sort of self-correcting mechanism that if you find that the lack of central bank buying sees wider credit spreads, volatility in equity markets, and that the Fed or the ECB can't course correct in terms of their rate hikes because of inflation, then inevitably what happens is you do have a flatter yield curve. So I think the most interesting part of bond markets today are the long-dated part of bond markets, because that's got the potential for yield curves to flatten and demand is there. I think places in emerging markets where you've already had rates going up, like in Poland, Hungary, Mexico, are also very interesting because they're much more advanced in their cycle. And lastly, the most interesting one is China, because China's actually already raised rates and the economy is slowing, and they're now easing monetary policy, and you get 2.5% for a 5-year bond in China. So I think there's lots of ways as a global manager that you can protect yourself and diversify your risk in markets that are offering much greater value than in developed bond markets in the West.
All right, playing policy divergence. Thank you so much to Miles Bradshaw, head of global aggregate fixed income strategies at JP Morgan Asset Management. And coming up, British Prime Minister Boris Johnson is planning to lift COVID isolation rules later this month as part of his government's strategy for living with COVID. We'll have details next. This is Bloomberg.
earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Let's check in on the Bloomberg Classified News. I'm Ritika Gupta. The European Union will snub a request by Russian Foreign Minister Sergei Lavrov for its member countries to respond individually to Moscow's demands on a regional security framework. Instead, the EU's foreign policy chief, Josep Borrell, will respond on behalf of the bloc. That's according to a draft of a letter seen by Bloomberg. The UK and US say Russia has accumulated almost 130,000 troops close to the border of Ukraine. Russia has repeatedly denied that it plans to attack. The new head of Germany's Bundesbank says the ECB may need to raise interest rates this year if the inflation outlook doesn't improve significantly. Joachim Nagel spoke to a German newspaper. He said the ECB has reached a point that's a textbook case for central bank action. And a New York judge has granted bail for 2 people charged with trying to launder billions of dollars worth of Bitcoin. The cryptocurrency was stolen in a 2016 hack of the Bitfinex currency exchange. Ilya Lichtenstein and Heather Morgan were arrested yesterday. The government says it seized about $3.6 billion of cryptocurrency from the couple. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Guy.
Ritika, thank you very much indeed. So the UK is moving beyond other major Western countries in easing coronavirus restrictions. The Prime Minister, Boris Johnson, speaking a little earlier in the House of Commons.
Provided the current encouraging trends in the data continue, it is my expectation that we will be able to end the last domestic restrictions, including the legal requirement to self-isolate if you test positive, a full month early.
The Prime Minister speaking earlier. Now, there are other things going on in British politics right now which may have a bearing on this decision, but let's talk about the science and whether or not the decision is driven by that. Bloomberg's Sam Fazeli joining us now, senior pharmaceutical analyst for Bloomberg Intelligence. Sam, let's put the politics aside, let's put Partygate aside. Does the science back what Boris Johnson is suggesting the UK does?
Well, no, Guy. I mean, at the end of the day, if you are out and about and infectious without a mask, I mean, it all depends on what the guidance will be, right? Because I think they're going to take it away from being a rule to guidance and hoping that people basically follow common sense. But if you're infectious and you have lots of virus coming out of your face and occupying the space around you and other people will breathe it in, you're going to start transmitting more. So these trends that we're dealing with now, I think, are looking great because people are still wearing masks to a degree, and when someone's sick, they stay at home.
But Sam, on the subject of wearing masks, we're starting to see those mask mandates lifted in schools and cities across the country. New York is expected to announce the lifting of the indoor mask mandate later today. Does the science back that up?
I mean, it's pretty clear that the CDC had some data, although some questions about the way the analysis was done, that shows if you have a high-quality mask, it protects you against the infection, and it certainly protects others if you are infected. That's not, I mean, that's undisputable. The point is, everyone wants to get back to what they call normal, and that's the problem which mask wearing does interfere with to a degree, but also having to self-isolate. But honestly, I think hopefully people's common sense will step in and say, if you're sick and infectious, don't go out.
What about pre-travel tests? We're starting to see those lifted around Europe. It's a hodgepodge, it always is. The Commission in Brussels would like to see it being a more consistent process, but it's not. But we are starting to see, as we approach, for instance, half terms, the requirement to have a PCR test or a lateral flow test before you travel being removed. Is that sensible, Sam?
Yeah, I've never seen the point of those things, especially when you have extremely high numbers in your country versus another country. I've never seen the point of that. Perhaps it helps maybe with people who have a healthcare system that's already heavily stretched. They don't want to add more people into that, a foreigner who can't pay, or whatever. I don't know what their thinking is. But relative to a country that's got 250,000 cases a day, 10,000 people arriving, even if 10% are infected, it's a drop in the ocean.
Well, obviously, there's the testing requirements for travel. There's also vaccine requirements for travel, some of which now mandate that you must have a booster shot. We actually just got a headline out of the White House COVID coordinator saying that the CDC is estimating 2/3 of eligible adults have gotten a booster, though those estimates probably exceed the official count because of data gaps. Sam, it seems like we've gotten away from the conversation about whether or not we're going to need more boosters after this, or just one vaccine that potentially would work against all variants. Where are we in that?
Yeah, so everybody would love to have two things happen. One, a vaccine that works against all variants, except you won't know it works against all variants until you get other variants in the future.
True.
So that's a bit of a catch-22. But you do want a vaccine that does more than give you what's called systemic immunity. One that protects you perhaps a bit more or better through your mucosa, like your nose, your lungs, and those kind of vaccines. People are working on them, and that's what I'm particularly interested in.
Final quick question, just coming through on the IB on the terminal right now. Sam, let me just read it out to you. What percentage of the population does the doctor, and I think he's talking about you here, Sam, but I know you've got a PhD, does the doctor believe are actually wearing the correct mask or even have them correctly placed on their faces? How important is the way we wear masks and the type of mask that we wear?
Look, Guy, that's an incredibly good question. You know, you walk around, it depends what country you're in, right? You walk around London, you see people with all kinds of masks. Very few, I think, I would say no more than 10%, 20%. I mean, you give me your estimates, are wearing the N95K, N95, FFP2, FFP3, really high efficiency masks. But I still say that even if you have a cloth mask, two people wearing a cloth mask, one of them is infected, that does reduce the risk. We all want to get away from masks, but I think we have to just, some more baby steps maybe is better. I'm going to keep wearing them in really crowded spaces.
All right, Dr. Sam Fazeli, PhD in pharmacology, thank you so much. Of course, he's also our senior pharmaceuticals analyst at Bloomberg Intelligence, our go-to on all things COVID-19. This is Bloomberg.